In this fifth and final video for Chapter 3 in Accounting 205, I would like you to go to the Office and the Home deduction, all right, and that is on page 324 in your book, all right. Okay, we're going to discuss Office and the Home and net operating losses and hobby losses in this video. The Office and the Home deduction is one of the most scrutinized deductions that you can have on your return. All right, maybe it's because it's hard to prove from the IRS's point of view. If you take a large Office and the Home deduction, they would have to literally come out and check you at your house, and if they wanted to. So let's make sure that we look at the requirements to have a legitimate Office and the Home deduction. All right, on page 324, they tell you that a taxpayer is not allowed to have an Office and the Home deduction unless they can meet one of the four tests on page 324. All right, under the first test or exception, all right, you must use your home office regularly and exclusively. Okay, all right. Number two, the second exception says that if the home is used exclusively and on a regular basis by patients, clients, or customers, that constitutes a home office. Number three, the home office is allowed if it is a separate structure away from the house, like an unused garage or a pole barn, something like that. Number four, the home office deduction is allowed if you use your home for storage of inventory. All right. Okay, so let's go back and review these a little bit. All right. Generally, the Office and the Home deduction is allowed if, for example, someone walked in your home and they could tell that you indeed have a home office and nothing else. For example, you're using a spare bedroom. When they walk in, it looks like an office. All right, you have a computer, you got a table, you got a chair, you got file cabinets. All right, something like that. All right, now if you just have a table and a chair and a computer in the room where your television is or where your laundry is or something like that, that's maybe regularly used, but it is not exclusive. Okay, and again, this is a really gray area because if you take the deduction and it's not exclusive, you know, the IRS literally would have to come out and check your house out if they wanted to, you know, if they wanted to verify your deduction. Okay, so what can you take on the Office and the Home deduction? All right, well, first of all, if you own your home, you can take a prorated amount of your real estate taxes and your mortgage interest. Now, how do they do that? Well, very simply, it's done by square footage. All right, so let's say you have a spare bedroom that's, 10 feet by 12 feet. So that's 120 square feet. All right, you would take that 120 square footage and you would divide it by the total square footage of your house. Okay, you could call any realtor and they can tell you what the square footage of your house is. It's public record. All right, or you can look back on your old real estate records when you bought the house. All right, so that becomes your percent of use. All right, so if your house is 1,200 square feet and you use 1,200 or 120 square feet, that means your percent of use is 10%. So that means you can deduct 10% of your mortgage interest, 10% of your taxes, 10% of your utilities. You can even depreciate the home if you want to, but I recommend you don't do that. All right, the reason is because if you ever sold your home, you technically would have to recapture that depreciation as income in the year of sale of your home. So that's why, and it usually isn't a really big deduction, so I just tell people not to bother with it. Okay, so if those are what we call the indirect expenses, because the expenses affect the entire house, all right? I've had clients who say, well, what about landscaping and stuff like that? That should be a legitimate expense, all right? If I drive up to your house and I can tell that is your home office, maybe because you got a sign out front, the fact that you have a nice landscape, should draw business into your house. So that should be deductible. But if you don't, just cutting the grass and all that stuff, no, that wouldn't be. Okay, direct expenses would include anything that you do to your home office. For example, if you painted the room, if you recarpeted that particular room, something like that. In other words, a direct expense that you can deduct 100% of. And of course, you can deduct your computer and your chair and anything else that you put in your home office. Okay, now, the one thing to note on page 324 and 325 is that the home office deduction cannot cause a loss, generally. The only time a home office can cause a loss on your return on Schedule C is if the mortgage interest and the real estate taxes are greater than your income, and that would be pretty hard to do. But that is noted for you right underneath the example at the top of page 325. Okay, so in other words, if you've got $1,000 of income before the home office deduction, then the home office deduction cannot exceed $1,000. In other words, the best you can do, if you go back and look at page 39, and if you come and look at line 31, the best you can do on line 31 is break even and be zero. Okay? All right. Sometimes people are like, I don't know what my total square footage is, and I don't want to go through all that hassle. Well, there's a safe harbor method at the bottom of page 325 that goes like this. All right? You can take up to 300 square feet of your home office times $5 per square foot, and that's like your standard deduction for your home office. All right, so again, if your home office was 120 square feet, you take that times 5, and your home office deduction would be $600. Okay? All right. So just, and remember that the limit is $1,500 if you're going to use the safe harbor method. Okay, on page 326, there's a very short discussion about net operating losses. All right, net operating losses generally occur because you had a loss on your Schedule C and, you don't know what to do with it. All right, well, there is a form. All right, Form 1045, and you will, it gets rather complicated, but when you have a net operating loss, all right, if you don't have any other income to use that loss against, all right, you can take that net operating loss and go back 2 years and see if you had a positive AGI in those years, and you can use your net operating loss in those 2 years. So if you were filing the 2017 tax return, and you had a net operating loss, you could go back and use it against your 2015 and your 2016 tax returns. If this was your first year of having a loss, there's nothing to apply it to. If you didn't have any other income on your 2017 return, then you could carry this loss forward for 20 years and use this loss on your 2018 return, your 2019 return, and so on until you use the loss up. All right. NOLs are very rare. They tend to be kind of complicated. All right. But again, they're very useful for claiming refunds in prior years or using it to get a larger refund in future years. And then finally, you have the hobby rule at the bottom of page 327. All right. Basically, if you have a hobby, okay, the best you can do is break even. You cannot hobby losses. Generally you are going to break even. All right. You have to prove that you indeed were doing this, for profit. If you're doing it for profit and you're actively doing it, then it's a Schedule C, and you can claim the loss as usual. But if it's just a hobby, the best you can do is break even. That's the end of this video for Chapter 3.